you can chuck all sorts of reasoning at this, that we needed to see a correction, it freshens up positions, the news flow's great, that the market, the volatility, this is a readjustment of leverage. What do you see going on in the markets, particularly as far as EPS is concerned? Where are we relative to valuations and expectations for the coming earnings season?
Q4 numbers were really good,
yeah,
but I think a lot of people had baked a lot of the tax reform in there. Now, here's the issue. So as you go forward, FY18, like calendar year 18 expectations are at about 18% year-over-year growth. So we're still going to tick up further. But the problem is, as you come around into calendar year 19 earnings, and everybody obviously is looking forward all the time.
Tough comparables.
The comps are getting tough, and I think people are already starting to say, okay, the tax reform was kind of a one-time hit or a one-time surge. Now where do we go? Now, the interesting thing about Q4 numbers were everything that we saw coming in where revisions to the Estimize data set for individual names were surging upward, they all crushed numbers. So you look at stuff like enterprise tech, specifically small and mid cap, and you look at Mark Beanoff, CEO of Salesforce, where he comes out and literally says he's never seen an enterprise technology upgrade cycle like this one. And it's very obvious. The economy at large is incredibly strong, and so you're going to get the capex spending on technology from all of these kind of middle market companies out there. Now, all of those companies like Zendesk, HubSpot, Workday, all blew numbers out of the water. Stocks did really well. The other thing that we saw was retail names that were left for dead, came back, had good numbers.
Talk to me about tech, though. Amazon, the president tweeting this morning, layering on the pressure here that he wants to tackle it. One of the darlings, whether it's Netflix, whether it's Amazon. I mean, we're watching it in pre-market down another 0.5%, and yet the numbers did really well.
I mean, I wouldn't pay any attention to what the president is saying about Amazon at this point.
To say that.
Look, they've done analyses of does the president actually have longer term impacts on stocks? And the answer is absolutely not.
Yeah.
So I would pay no attention to that. Amazon individually, again, blew numbers out of the water against massive upward revisions to the estimized EPS and revenue numbers. We also look at the AWS revenue, which is also another signifier of incredibly strong enterprise technology spending.
Yes.
They blew those numbers out of the water. There's no reason to believe that that's going to change. GoDaddy just said they're moving all of their stuff over to AWS.
Yes.
That business is on fire. And, it also signifies just incredibly strong performance from the consumer. And we look at stocks like Invisalign, Align, which has done incredibly well, where we've seen upward revisions to the data set across the board, especially going to Q1 as well.
Very quickly, in a prior life, you were a quant and you looked at behavioral finance. Put what we're seeing in the markets right now in perspective, given what you know about the structure of the market now.
Yeah, so obviously you have a lot more kind of statistical arbitrage trading going on. What's interesting, though, is that you look at what Rentec came out and said a couple of months ago, and they never talk. You never hear a peep out of them. What happened was basically the market had run up too much. Some of those reversion models had gotten completely out of whack. They were bleeding money like hell, and they came in and talked the market down. To have quants come out and attempt to talk the market down into their strategies is
bonkers.
A bonkers new thing that you don't see too often, and it speaks to the fact that discretionary managers have to be paying attention to the strategies that the StatArb guys are running now.